The stock market, as seen as the S&P 500 and the valuation of it, game changer. It's a game changer once you understand valuation, not because you can predict the future, but because you'll know what it should feel like in terms of prices. So today, it's an update in response to yesterday. It was looking pretty hairy. I expected just to hang out here. Usually when you have those big up days or big down days, they keep it underwater or they keep it above water in the air, just liquidating those margin calls. And it takes a lot of effort to move the market in either direction. If you look, Apple was on the ropes and then they squeezed it up today. But it's an inside bar. Inside bar meaning it has to break out of the range from yesterday. The Apple range was somewhere, well, actually, I can look right there, high to low, 131 and 125. Until it breaks out in either direction, it's a nothing day. If it breaks out above, cool, we rally. It gets more valuable. If it breaks down to the downside, cool, it goes down. No big deal. Eventually will be a buying opportunity. But sticking to the plan, I want to go over a little more information. Since it's going to be a boring day, I want to go over valuation. And I've been speaking with friends, smart guys, and we've all been contemplating what it means to be in a market during inflation. If this is true inflation, if costs and prices are going up, if everything is getting more expensive, what does that mean for a market that's pretty much going sideways? If you look at what the S&P has done over the past, is it basically the whole year, it's gone nowhere, right? Jan was around this price. Actually, that's two years. Isn't that's even worse? So for the past 2 years, it's gone nowhere. It went up and it gave it back. And then if you factor in that we had high inflation, that means everything went up and the money parked in the S&P, ignoring the dividends, didn't keep up because things are more expensive. Well, the topic I want to bring up is, where is it? The rule of 20. The rule of 20. It's, a shortcut guide to valuing the market, but also including inflation. The rule of 20, I'll just read what the headline. The rule of 20, stocks historically bottomed when trailing PE and CPI was below 20. So they're going to take the price to earnings divided by price, but they're going to add back in CPI. And I'm not so interested in when the market bottoms, but look at the range. This is, let's call it 100 years. It's almost 100 years. And look at the highs and the lows. If you add inflation, whatever the CPI is at the time, back to PE, it's going to make the PE look worse. And if you look at, there's really only 3 times when the PE plus CPI looked really bad, and that was when it was above 30. That's looks like 1946 when there was a lot of inflation. I'm sure if we go back to 29, that may have been kind of high. 2000, 46 was also during war. But 97, 2000, it says 97, but that's 2000. When PEs got out of hand, above 30, there wasn't inflation then because the discussion was productivity, but PEs were very high. And then this must be somewhere where we are right now, if this is accurate. if you add the CPI, I know the current PE is 20 and CPI is down to 7, so it's around 27 right now. So those were hard times to own stocks because they were expensive and inflation was creeping up, eroding value. That's what inflation does. Inflation is a tax on wealth. The government prints money for its activity and it makes the dollars in our pocket less valuable. That's an inflation tax. We don't like voting for taxes. Government says, fine, we're going to spend anyway. And it erodes the value by increasing the money supply. Now, so those were the tops. Now let's look at the bottoms. Whenever you see this number, which is PEs and inflation really low, that happens to be a great place to buy stocks. Probably very scary, but when you see PEs in the 10, and when the market is falling, there isn't inflation. I mean, there's money printing, but when asset prices are falling, we call that deflation. When there's people want capital and are preserving capital and are hoarding capital, usually that's deflation. Money destruction, that's deflation. But a PE of 10 with low inflation, that's when you want to buy. I really did live through 0809, so that one's very familiar. But all the good companies today, all the stocks that are very expensive, they were super cheap on valuation and price in 2008 and 9. Fantastic companies, and they were trading in a basket, all very beat up. And there was bad news in the streets, and everybody had a bad story of something bad happening economic wise, and that was the environment. We are not in one of those environments today. If I jump over to Shiller PE ratio, which is it's the same thing. It's the PE but with inflation adjustment. They basically just add the PE plus the CPI also. This one does include the Roaring 20s, 1929, and then it does even this one's closer to 150 years. Let me make it bigger. If we look right now, the PE, according to the rule of 20, it's on the high side. It's above the rule of 20. Let's go back to this line. The rule of 20 says it's a good, on average, the rule of 20 is like a fair value. So you want to be careful when the CPI and PE is above 20, and you want to be more bullish when it's below that regression line of 20. So if we look, anytime we're below 20, it's a better deal to buy stocks. Anytime we're above, it's not so good. We're at 28 right now. 2000 was almost 40, 43. We want to see something in the 15 or better. And that's basically the rule of 20. Another thing I want to point out is in 2000, growth stocks were expensive relative to GDP and the economy. And one way we can look at that is growth stocks are usually in the NASDAQ. We compare it to GDP. You got to make sure you select gross domestic product along with the little e for economic data. Let's get rid of the moving averages. And in 2000, yep, this validates that GDP is the denominator. And whenever the NASDAQ or the value of stocks gets too expensive, too optimistic, but the GDP doesn't keep up, this chart will show that. The other way to look at it is NASDAQ compared to PCE, which is like a concentrated version of CPI. same picture. We're in a double bubble. We look at NASDAQ compared to gold, a double bubble. We look at NASDAQ compared to diamonds, or let me do NDQ, DJI, the Dow Jones. The Dow Jones doesn't usually bubble the same way because they're larger cap, dividend paying, more boring companies, but they don't get the same multiple expansion that the NASDAQ does. And again, we see a double bubble. So more likely, the rule of 20 is right, that we're more on the high side of the market, and we should be more careful with our investments. 28 PE historically expensive. Now, this is just for the market. Not all stocks are at 28 PE. Like there's other stocks. For example, Meta got crushed. And do I have these metrics? Yeah, I do. So it has a PE closer to, I think, 12. Earnings yield is 8. And price to cash flow is 6. Let me just add PE real quick, just to make the point. Yeah, it's 11.5. So not all stocks will have the same PEs. It's a market of stocks. But that's how I know I gotta stay careful. I gotta stay careful, be vigilant. Another way to look is if you look at junk bonds or high yield bonds, whenever there's a good generational buying opportunity, you'll see fear in the market. And if you're not sure, you want to look for huge volatility in the bond market. And the yields haven't spiked up yet. This is actually not a big spike yet. You would see a big, what did they drop in 08? They dropped 33% and they were paying 20% yields. I think right now they're down 15% and the yield is only 7, 8, 9, something like that. And we still haven't seen a massive volatility. We haven't seen a massive spike in volatility. Volatility is elevated, but we had that high spike during COVID crash. Volatility went to 80. In 2008, volatility hit 95. Right now we're at 20. Volatility just measures the price of options at the money, and it spits out a pricing implied volatility number. So the price of a call at the money, the price of a put at the money, which is at the current price, you add them together and you annualize it. It'll give you some number relative to the share price. They're pricing in 21% price movement volatility. When things get really wild, people are scared or they're bearish. They buy puts like crazy. If you look, Apple got scary yesterday. The volatility on Apple hit 40. That's starting to get scary. 40% volatility is quite high on average. So stocks are not cheap. That's the whole point of this message. And how you would know is using something like this, like the rule of 20. Just tell yourself, hey, if inflation stays elevated, that's an expense, and you have to add it to PE. Either inflation comes down, or PE has to come down, or earnings have to go up, but something's got to give. I would screenshot this picture and save it, add it to your files of useful pieces of information. Share it with your friends. It's important to have a discussion like this. You got to make investing and money concepts a lifestyle. Hope you found this useful. Cheers.